Now that we've had a long and fun conversation on China and what the new policies stand for, now we're going to turn a little bit more global and US centric to look at, all right, well, what's happening in the US, what's happening globally, and where's the best place to start with the IHS market data as we continue to look at some of the PMI expectations, what's happening. And we have to appreciate, October data's out. November is obviously a little bit different now that we have lockdowns in Europe, but it's important to understand where we are going, going forward. And obviously, before we get fully in depth, please like, share, subscribe. Your support is appreciated. Any questions, please put them in the comment section, because hopefully you've seen I am very active and try to get to everyone's questions or comments and try to provide any kind of clarification that you may need. So here you can see the Capex intentions, and there's going to be some charts that kind of counter this just because it just comes down to when did the data get released. But again, even though the data has gotten a little bit worse, it's especially in Europe, you can still see the Eurozone, UK, see an increase in with some less pessimism. Things have softened up a little bit, but again, people are still expecting Q4, even with the lockdowns, to be a little bit better than initial views in April. The bigger issue and what we're seeing now is the expectations for 2021 to be weaker than initially perceived, which is something that we've been saying for an extended period of time. We think that 2021 guidance was too high. We still think Q4 is a little too high just because even though we have lockdowns, we still see an increase in cases. The question is now going to be, as we go into winter, are we really going to kind of be able to handle where some of these issues arise? Because if you look at when did it really hit the US, when did it hit Europe, it was really March, April, when we were coming out of winter into spring, and now we're coming out of fall into winter. So it'll be interesting to see how that dynamic shifts in terms of total consumption and activity, which, ideally, what we're thinking is it'll be a negative impact overall, because it's just people are going to want to avoid that exposure. Now, U.S., Japan continue to see those optimists, the optimistic side. Japan is the one that hasn't seen that shift, and we'll talk about that in the last segment, just because it's an important component. But the U.S. is one that's starting to see a little bit of slowing in terms of just kind of what the intentions are on that Capex expansion, which is obviously paramount when we're looking at that GDP component, because obviously it's not only just consumption, it's also government spending, then it's investment, and then obviously our exports minus imports. So here, when you look at global business activity expenditures, expectations, again, this is showing you how things have gotten better, especially as they got better in October. The bigger issue and the bigger headwinds are as we come into November, how much of that will be impacted based on the renewed lockdowns, cases, and whatnot, which we think is going to increase in pessimism. But again, it's not something that we think is going to go too much lower. It's just important to appreciate, and this is why we've been talking about this. Look at 2017. Look at where the net balance of optimists less pessimists were. So when we look at the optimistic level, people were more optimistic as we were in 2017. And then they were a little bit less optimistic in 2018. Then they weren't optimistic. The pessimism continued to ratchet up as we went through that 2019 component. And now, again, kind of showing that natural progression of the net balance of optimists, less pessimists. And just the optimists were we were starting to see those issues starting to crack and starting to come up in 2019, which is just important as we appreciate kind of where we sit on a go-forward level and what could possibly happen as we go into, again, another lockdown, another slowdown. It started before COVID. Again, COVID was that jet fuel on a forest fire, but it's not the first time that we've seen issues on the data front. So this is just that change in optimism when we're regarding business activity in 12 months' time. So as we look out 12 months, how have things gotten better or worse? And let's just start with the global. So here you can see the chart showing the net balance again of net balance in October compared to June. And here you can see things have gotten a little bit better when we're looking at manufacturing is the one that has seen a little bit less expectations of increases, which again, we'll talk about in a minute. But the services is the one that saw a little bit of a bigger increase, which is the one that's we think is rolling back more as services continue to underperform or at least kind of miss estimates in the market, which will again slow down the total composite, which again, it's just going to be a matter of like, this is October data. It's going to be interesting to see how does November look like as we see some of these increase in cases. But even though we're seeing an increase in cases, which is going to weigh on some of this data, what are people doing? Americans engaging in less extreme social distancing. And again, we've talked about this in the past. Just because things are getting worse doesn't mean you have the same type of buy-in. People are now more cognizant of what is happening and what the ramifications are. So what are they doing? They're limiting, they're wearing masks, they're washing their hands more. They're trying to mitigate some of these issues while maintaining some sort of normalcy. And those are things that we don't see stopping, which is why, again, coming back to what is the buy-in and the complete and mostly isolated, let's say peaked at about 69%. Again, we're at 38%. We're just not going to get back to those levels. Even if we do see an increase in deaths, an increase in lockdowns, people will still go about their day way more than they have in the past, just because it's going to come down to what does the ICU look like? What does the hospital look like? What do deaths look like? They will continue to, again, hospitalizations will have increased, but they still remain, when we start looking at deaths and we start to look at time in the hospital, those continue to shift lower, which is giving people some pause when they're thinking about, well, do I have to stay home or can I go about my day? Maybe go to the store once instead of twice and still practice my safety. And these are things that is why when we start talking about, we're not going to see the same type of demand destruction we saw in March and April. It's going to be more gradual. It's going to be more persistent. And it's just that's why we see that delay in terms of some of those pops. And the other issue, and again, coming back to our request of, giving us your support, is small businesses are losing confidence. So this is the bigger issue as we start to go into November. Again, like some of the data was from October. Now let's look at the U.S. and let's look at, well, what are people thinking? What are small businesses thinking? And as we've seen, there's been a lot less, stimulus has essentially fallen out of the headlines because, what is stimulus going to do? Are we going to get stimulus? Where the market's at all-time highs. Do we need stimulus? And that's why November, based on the situation today, do you think your business will survive? And we are seeing more people saying that they don't know, which is unfortunate because when we think about small businesses, this is the biggest driver. This is the biggest employer within the U.S., which is going to be a problem as we start to look out through the remainder, not only of Q4, but also into 2021. Now, how is that reflected in what's happening in the market? And again, Chase Consumer Card Spending Tracker has shifted lower. Again, this is something that data through November is showing that 6.6%. We think that continues to shift down as again, when we think about seasonally adjusted, people not spending as much on the holidays, jobs coming into scrutiny in terms of, will I have a job? Permanent layoffs are increasing. Again, these are things that are being reflected in the way people are using credit and especially just spending overall, which then leads into, well, what's happening in same-store sales? So the Johnson Red Book Index, looking at it in different metrics. So the top one is looking at weekly year over year. It fell below estimates. It was still positive, about 1.1%. But the bigger one, which is looking at the month over month, we actually had a surprise to the downside of 1.2%. So again, that's kind of that slowdown that we're talking about. And it's something that we think is going to continue as we look out over the remainder of November and as we project into December, that we're going to see same-store sales continue to dwindle and go lower, which again is showing up in some of these revenue components, which is why when we look at the Small Business Uncertainty Index, it is now shifted to that new high. Now, this is twofold because obviously COVID is there, but now, does the Senate have the majority? We have a potential runoff, and I think it's now official, a runoff in Georgia. The Republicans gained some House seats. The Democrats have maintained the majority in the House. But, now is Biden going to solidify? President Trump has multiple lawsuits in several states. Is there any credence to that? Was there any manipulation of the election? These are things that even though it's like, well, we see what's in the news, but is it real? Is there something that's going to change that? And then obviously that all bleeds down to what's going to happen with taxes, what's going to happen with the corporate tax rate, what's going to happen with the personal, with cap gains, what's going to happen overall with taxes when you have a potential Biden presidency and a Senate that is going to most likely be Republican. What does that look like? And then that is really shifting. Are they going to invest? Are they going to hire? Because they don't know what revenues are going to look like in 2021. So when we look at the job openings, again, the survey was for 6,500, actual, I should say 6.5 million, actual 6.4. And it's just, again, that slowdown because we're starting to see things cool off on not only just the seasonal level, but also the unknowns as we look at COVID and we look at the election as we head into 2021. Now, the non-farm payroll employment, so this came out last week. The numbers were better than expected when we were looking at estimates. Again, overshot ADP. Always interesting to see kind of the dynamics of the numbers overall. But here, again, the drop and the bounce. And you can see that we're starting to slow down. We're starting to see these headwinds that we've been talking about starting to get pronounced because obviously, you're going to get a strong move down and then you're going to get a strong bounce. But the question is when does that become more of that swoosh, if you will, or less of that V-shaped recovery? And we're starting to see that as we see a lot of this persistence in slowing economic data and just where do things shake out? And that's why we think that we're starting to see some of this ebb and it's going to impact overall what spending is going to look like as some of these jobs where the employment's still low and we're starting to see an increase in permanent unemployment. And that's why when we start to look at permanent layoffs. So you can see that now this is the place that you don't want to see a V-shaped recovery is the share of permanent layoffs is rapidly rising. And again, as we talk about other recessions, we've seen it rise, in the same level in terms of the last one was 22 basis points. And again, you can see how kind of slow that was and what the slow move. We expect something similar as we talked about in the first segment when we looked at previous slowdowns and previous recessions. This one will be no different. And the only problem now is a lot of these companies, corporations, governments are sitting with a record amount of debt. So the question is, well, how do you finance your debt given the fact that you have all of this, a lot of overhang that's going to mitigate against some of this new hiring? And this is looking at it in previous years. So when we look at permanently unemployed individuals relative to the labor force versus previous recessions, you can see how we're really outpacing that. Now, it has slowed. Again, it's just one little blip because you can see that there was one previously, then we continued higher. When we look at renewed layoffs within companies that have been announced, there's a lot of reasons why this is going to continue. The slope will slow down, and it's something that we think will slow down overall. But it's just when we look at 2008 to 2009, we see something similar just on a bigger scale. Because when you look at 08, 09, you had layoffs at the banking sectors, mortgage origination, some of those ancillary sectors, obviously because of that trickle down from those components. This is much broader. And we already had issues in 2019 leading into 2020. So that's why the slope up will be sharper, and then that kind of that drag down or that recovery lower is going to take much longer to really recognize and see all the way through. One of the benefits, obviously, because we talked about some negative stuff, is where the labor force participation rate is starting to improve. Again, it's still at a 1977 level, so not great, but again, at least starting to see some of that activity. And as more people feel confident that they can get a job, they will re-enter, and that will kind of adjust what the unemployment rate actually looks like, because participation rate is a big factor when we're considering what does unemployment look like overall. Now, we always try to show different data points just because we think it's interesting and it's ways to kind of get ahead of the curve. And the job hunting searches fell sharply in October. Now, the question is this really going to adjust in November now that we see increasing cases, some additional lockdowns in different areas? The likelihood is it'll continue lower. But again, it's not going to really continue as sharply because we don't think we're going to get to those April lows. we're just going to kind of normalize and I would think bump along the bottom as we head into December. Now, this is just looking at the Google trends. Now let's look at ZipRecruiter. And here you can see average daily volumes overall. So transportation and storage, obviously up and out. That's something that has seen a large increase in job creation, or at least I should say in postings. Retail, something similar, again, kind of getting back to normal as some of these places reopen. The bigger issue is some of the other components that saw some big drop-offs. We're just not seeing a recovery to the same level. Where you continue to see contraction where we're still below that 100 mark. Again, these are things that, again, are just going to persist as we head into the remainder of the year. And as we go, again, job hunting, this is looking at it from the perspective of different areas. And you can see that there's really all areas are trending in the same direction. Some are just a little bit slower than others. East, South Central, South Atlantic continue to see the slowest slowdown, with New England and I should say the coastal areas seeing the biggest drop-offs, which is being driven based on lockdowns and obviously cases. But this is something where we don't think we're going to get to the lows we saw in April. But again, we're just going to kind of normalize and we think bump along the bottom as we head into the remainder of the year. And it's important to appreciate, well, what's going to happen with mortgages and delinquencies. And this is something to highlight because delinquencies as percent of total mortgage, it actually got a little bit better. So this is a little dated. But again, you can see the peak in the 2008 housing crisis and where we are right now at the COVID-19 crisis. And obviously there's been a moratorium on evictions. So some of these delinquencies as percent of total mortgages is going to go up. But remember, there's more mortgages right now, so that the denominator is also getting bigger, so the percentages could be adjusted, just to kind of put that into context. But you still get an idea of just how sharp and how vast that increase is, and what happens as we head into January with the uncertainty of, well, is that moratorium going to be extended, or are we going to see that expire and there's going to be a huge increase in evictions? This is going to be something to watch as we start to look at what is supply looking like as we head into the new year. Now, just some correlations when we look at ISM new orders today versus 1976 to 84. Again, looking at a move from stagnation into inflation. And again, there's some similarities in terms of trends. Again, it's always hard to predict just because as we look at, is it a V shape? Is it a W shape? Is it a K shape? I mein, I guess pick your letter of the alphabet. Here you're seeing that, it's trending pretty closely to where we were with the recessions in 2000 and 2080. In 1980. I can look into the future if only. And in 1981. So here we're seeing, what those slowdowns could look like and what that trend looked, kind of carried through. And that's why, again, we start to look at a lot of those leading indicators, which give us pause as we head into 2021. Now, last slide before we end this particular segment is when we look at the tightening standards. We continue to talk about those commercial and industrial loans versus commercial and industrial loans as percent year over year. And here you can see that the tightening standards continue to ramp up, which is, again, going to limit the new loan growth. And that's where we think there's going to be a continuation of some of these struggles. As a lot of these companies have kind of maxed out, we've seen them actually reduce their revolvers. So we could see a little bit of a loosening in terms of some of these restrictions, because now there's a little bit more freedom when we start to talk about your collateral that can be put against it. But again, it's just important to show, because we've been talking about this for some time, not only here, but in Europe, which we'll talk about in the last segment, looking at what's happening with loan growth and how this is going to be a bigger headwind as we go through the remainder of the year, as standards tighten, again, spending on Capex, new employment. The loan growth is going to be a overarching problem as we head into the remainder of the year and obviously project into 2021.